Well, good morning, everyone from Melbourne, and welcome to our quarterly Property Insights webinar. My name's Adam Holster. I'm the Professional Services Banking Executive for Victoria, and I'll be your host across the next hour. As we begin today, I'd like to acknowledge the traditional owners of the country on which we meet today. I come to you from the lands of the Kulin Nation, lands of the Wurundjeri people. They're the traditional custodians of the land on which I stand. I want to acknowledge all elders past, present, as well as future leaders who continue their role as proud custodians of the country that they belong to. Today, I'd also like to acknowledge our Indigenous clients and colleagues who join us from around Victoria and Tasmania today. Lots happening in the property market as always. So thank you so much for dialing in. Two panelists with me today that I'd love to introduce you to. Gareth Spence, he's our senior economist at Australian Economics at NAB. He provides detailed analysis on the Australian economy. He spent the last 6 years at NAB doing that, and prior to that role, 10 years with the Reserve Bank of Australia. He'll be joined by Mark Browning, our Head of Valuations at NAB. Mark's been the Head of Valuations and Property Advisory for the last 6 years. He leads our valuation team across NAB. He's a career banker of some 25 years, leading banking teams across corporate, business banking, credit and risk, as well as operational and product functions. Mark holds an Executive Masters of Administration. A little bit of admin before we throw to Gareth. We're going to have our Q&A function open today. It creates a lot of engagement. I know in our meetings that we're having with clients, recently there's a lot of conversation going on. I'd encourage you to put those questions in the Q&A function as they pop up. Our panelists will either answer them in real time as they can, or at 10:15 we will throw to a dedicated Q&A function to make sure that we get through those things. Also, at the end of the Zoom today, you'll be taken to a screen with no more than a couple of questions, a survey. This helps us make sure that we really hone this content for you to make sure that it is as valuable as what it can be for you. But without anything further, Gareth, can you take us through the macro and a bit of domestic economics and what's happening? Put it all in perspective for us.
Thanks, Adam. I'll just pull up my slides. All right. Thank you for having me along today, everyone. And I guess with 20 minutes, there's plenty going on. So kind of a high-level update on sort of what's happened since we last did these seminars around 6 months ago, and maybe how we think we're kind of playing out now and where we'll go over the next year. So very much a similar set of themes to 6 months ago, but maybe a little bit more progressed. The pandemic impacts, they're kind of well in the rearview mirror now. And really we're facing into kind of, a new set of shocks globally, and also sort of, kind of that tail end and ongoing adjustment to kind of a higher level of interest rates globally. So my four big sort of themes for 2024 is, kind of what happens with global growth following the big increase in rates, I guess globally and locally, how inflation continues to kind of moderate. That will be important for sort of growth itself, but also where interest rates and monetary policies go. And for Australia, I think we'll get to this, but our outlook is broadly that we'll kind of continue the year, at a very slow pace in terms of growth, but in somewhat of an optimistic sense, things will start to pick up in the second half of the year if we're right. And lastly, as usual, we'll probably touch on some of the supply and demand imbalance that, you're all well across in the housing market, but I will leave much of the specific details to Mark as the expert. So I guess just touching globally, the good news is inflation has continued to moderate. It's now well off its peaks across most countries. You can see there that it's come down a fair way, but it is generally slightly above or a little bit above actually, returning to central bank's target across most countries. So kind of really good progress so far, but a little bit more to go and a little bit of uncertainty about, just how quickly each country will sort of return back to its sort of long run or, target rate of inflation. I guess alongside that, what is a little bit clear, I showed this graph last time now, and almost all the lines have kind of tracked sort of sideways on the right-hand side there. But, with inflation having clearly peaked and continuing to ease, we're quite confident most rates have peaked. It's just a bit of a question of how long each sort of central bank will kind of hold at those levels. And then, through 2025, just how quickly do they cut back towards something a little bit more normal. Alongside what's happened with rates and inflation, growth has clearly slowed as we expected. It's quite slow in the in the UK, the Euro area, New Zealand, for example, with the exception being the US, which has actually been quite strong. So, on the rates front, it does look like we'll sort of start to see easings from places like Canada, the UK, the Bank of England around the middle of the year, and the US around sort of Q3 before Australia and New Zealand finally move to start easing rates late in Q3. The good news is, while growth has slowed, labour markets have generally held up. So unemployment rates have generally risen across most countries, but they do kind of remain quite low. So the backdrop is quite positive in sort of how the globe is navigating some of these challenges. The flip side of that, of course, is the geopolitical tensions that we've kind of seen around, and the uncertainty over energy prices. But turning to Australia a little bit more specifically, how have we tracked over the last 6 months? Well, I think largely for us, it's really a story of that we've kind of started to see more and more of that impact of rising rates through the preceding 18 months on the economy. You can see here that consumption growth has kind of slowed quite sharply through 2023. It rose just 0.1% over the year, which is quite soft. That compares to something normal of around 2 or a little bit above % per year. But you can also see there that, we think we're kind of around that sort of trough in growth. What you can also see there is, consumption growth has certainly slowed over 2023. The adjustment in per capita terms or per person has actually been a little bit more significant. So we're actually falling a little bit, but in aggregate, it's kind of, been flat. The other important factors that really supported growth for us is kind of public spending, particularly on infrastructure. So those big projects across most of the states, as well as a recovery in trade. So that's kind of to Q4 last year. How have we kind of continued into early 2024? Well, I think reasonably well. So business conditions from our NAB business survey, where we go out each month and we ask businesses, what is your profitability, your employment levels, and your trading conditions like? You can see certainly eased through 2023 from quite a high level, but probably the biggest story is it appears to have stabilized at something a little bit above average. So, certainly slower than it was through early 2023, but still reasonably healthy as we've entered this year. Some of the dynamics to kind of update you, I think we looked at this graph last time. It's quite interesting, but I think is the real driver of that dynamic where we need to see consumption pick up to see growth really return. Is the impact on household budgets and household incomes from I guess the key factors, right? So you can see there that the black line, which is just disposable income growth after the impact of interest payments, tax, and also the impact of rising prices. So what happens to purchasing power? Fell in annual terms for around 5 to 6 quarters. That's quite significant. It's not something that usually goes backwards, but does speak to just how strong some of these forces have been. And primarily prices, you can see that the subtraction there is quite large in the blue bars. But of interest as well, I guess, and this will come up later on, but also later in the year, we're looking towards tax cuts. So the drag from a higher tax burden as bracket creep has kind of fed through because of strong nominal wage growth, has been quite significant. And of course, interest payable has as well. As we mentioned last time, though, the labour market has been quite healthy and sort of wage growth has picked up, employment levels are strong, and hours worked have actually risen. And so kind of offsetting in aggregate, some of that pressure from those downside factors has actually been quite strong labour income. So, I guess the real news in here compared to last time is, it looks like we're past the peak of that pressure. It actually sort of rebounded in Q4 last year. And as we look forward this year, maybe not imminently, but eventually we'll see some rate cuts, which will ease this pressure. Inflation will continue to fade according to our forecasts, and eventually we'll see tax cuts as well. So actually, some reasons to be optimistic on the supports to households in the second half of the year. As we all know, a bit of pressure still flowing through in the household sector. Just to kind of update from our consumer survey perspective, alongside that easing in pressures on income, we actually saw the first quarterly fall in our consumer stress index from our sentiment survey in Q1 this year. So kind of lining up quite nicely there. Where is the stress still concentrated? Well, maybe not so surprising, but the unemployed, renters, and those with kind of lower incomes, which are really pressured by some of those factors that we've talked about. Again, there is a balance going on here, or sort of a shift in consumption patterns as we face into those pressures. It still remains that the biggest sort of adjustment has come through, I guess, what I'd call kind of the luxuries, or, the really discretionary type purchases. So, around 57% of our respondents in Q1, kind of reported cutting back on eating out, eating at restaurants, the micro treats, so the coffees and snacks, and then a few other discretionary things. So, entertainment, cinemas and theatre outings. But also interesting, with high petrol prices, people have tried to cut back a little bit on car journeys. I guess the flip side of that, so the bottom right chart there, what have people really tried to hold on to? So, adjusting their spending on the discretionary side. You can see their school fees kind of still take a bit of a priority. Children's activities, sport, pets, and even home services, as well as insurance, are kind of, seen a bit of a less adjustment than some of those other categories. So certainly the pressure coming through and an adjustment going on. I guess in aggregate, something else we're looking at, but you can sort of see here that, they've reduced spending, they've made some adjustments in the composition of their spending, but also actually households have just saved a bit less. That ratio had fallen quite strongly as we kind of came out of the pandemic, but again, does look like it's sort of stabilized. So it looks like some of those pressures at the margin have kind of, already eased, or at least we're at the peak, and it's really about how do households and their confidence kind of continue from here as to how that big important component of GDP kind of continues through this year. I won't go too much into house prices. I'll leave that to my colleague Mark, but I just reflect again that, we've got kind of this adjustment going on the consumption side, but from our perspective, the housing market has been quite challenging. So price growth has certainly been quite strong on average across the capital cities. The rental market is still exceptionally tight, and rents are growing quite strongly with those very low vacancy rates. But the construction side is challenged, and we'll touch on that again. So, our outlook broadly for house prices is that they'll continue to rise through the rest of this year. We have seen some, slowing on average. Mark can allude to some more details, but really, just the sheer strength and demand in the housing market is kind of offsetting those pressures from higher interest rates and reduced borrowing power. To kind of touch on one of the really big stories nationally, but certainly at a state level as well, is population growth. So it's continued very strongly. We've got, a little bit more data since we last spoke. Population growth across Australia is now at about 2.8% annually. That's around 550,000 migrants and over 600,000 in total. And I guess that's been quite a key story to supporting the aggregate economy and aggregate consumption, but also placing that pressure in the housing market. On Victoria, you can kind of see there in the top panel that, really the story there is the big return and the strong return and rebound in overseas migrants. We kind of wondered how quickly we would sort of catch up on all those missed migrants when borders were closed. It turns out we're now well past that level. So it's really showed up in places like Victoria and New South Wales, where overseas migration is kind of your traditional driver of population growth. Also, interestingly, interstate migration is kind of starting to normalise for Victoria. So had been a bit of a drag through the pandemic and a little bit after, but looks to be levelling off now. So things are kind of normalising. But in a working age sense, population growth, well over 3%, which is the strongest for quite some time. Tasmania actually gives us one of the rare sort of state contrasts. So, Victorian story is a little bit common. Tasmania population growth actually slowed a little bit. So certainly seeing that return or, rebound in overseas migration. But a big difference to kind of pre-COVID or a switch in a trend is is the net flow of interstate migrants, which are now kind of leaving and flowing out of Tasmania. So a slight contrast there, and maybe showing up a little bit in some of the property metrics. The supply side still looks quite challenging in the housing market. We got the latest data for Q4 last week for this. You can see that, dwelling completions have kind of, slightly trended down, but, kind of broadly tracking it at a relatively low rate at a time where demand is quite strong at 173,000 per year. You can see there that Tasmania is actually at quite a high level in sort of completions and new supply relative to its historic trend, but the Victorian line, which is the black one in the bottom left panel, it's actually a little bit weaker and still trending down. So again, maybe a bit of a contrast between the two states there. The pipelines are actually still elevated across the states, so lots of questions, and we don't have a solid answer to this yet, but in the face of such strong demand and kind of healthy price growth, why is supply still so challenged? I think something that's coming through quite strongly is certainly the cost story. So, inflation in housing input or housing construction costs has certainly eased. It's tracking at about 5% a year, which is still quite strong, but it's certainly well off that 17% that we had at its peak. I think the issue really is here that, we actually haven't seen quite a normalization in any of those inputs. So despite inflation slowing, prices are still about a third higher. In our residential property survey, which we'll shortly release, respondents generally tell us that that's indeed the case. So construction costs are, reported by about 76% respondents as the major constraint on new developments. You can also see there labor availability is relatively high still as a constraint, and then the usual delays or, difficulty in attaining planning permits. So something we'll keep watching, something that is quite important for inflation. I guess more generally, some data from PropTrack sort of shows us that, affordability has taken quite a hit. So with prices still rising, but interest rates also very high, the net result is that, households are actually spending quite a high proportion of their income on housing. This PropTrack measure from realestate.com basically shows us, the proportion of dwellings that the average household could afford was spending 25% of their gross income on housing. You can see that that's around the lowest level in 30 years and just 13% of the sales across the realestate.com.au site over the past year. So, the housing sort of dynamic is going to be quite key for a few reasons. It's going to matter for growth on the construction side. It matters for productivity with, the flexibility and the ability of labor to move around the country at a time where we know it's still quite tight. And also just the fact that, the housing components of the CPI are around kind of 15% of consumer spending. So what the prices in those sectors do will be quite important. Labor markets have stayed quite healthy, so growth certainly has slowed. Level of activity is still quite high. Our measure of capacity utilization in the business survey is still well above its average. And you can see there that unemployment, across Australia, but also across the states is still quite low. It's drifted up a little bit over recent months and there's been some volatility, but you can see that generally remains around 4% across the states and quite low across a few of them. Job vacancies, which is sort of our forward-looking indicator of employment, says that actually, things have kind of cooled a little bit. So labor demand has slowed, but the vacancy rate, job ads, and the vacancies per unemployed people is still quite high. So, despite that slowing in the economy, it looks like the labor market has remained quite healthy and will do in sort of the near term. So again, what have we said about that? Well, really, wage growth has picked up. We think it's around its peak. So, that really tight labor market, those large minimum award wage increases are certainly fed through. On our best measure of wages per hour, we're tracking about the strongest since the late 2000s. It's certainly accelerated across almost all industries, but has been strongest in health, education, and training over the last year with that minimum wage increase really impacting those sectors. So that will be quite important for inflation, as we go forward. But as I said, many moving parts. So good news for Australia is, maybe we lagged sort of on the way up on inflation with some of those global factors. we've actually moderated quite quickly, and maybe we've overtaken a few of the other advanced economies. So on our monthly indicator, inflation's back to around 3.4%. We'll get some quarterly data over the next couple of weeks, which will actually really give us, some better or stronger insight into the true dynamics. But the good news is, we've been able to bring inflation back from up near 8% to almost back to target, with relatively little pain or scarring in kind of the labor market or a more major downturn in activity. And I guess a lot of that support or a lot of that easing in inflation pressures to date has really come from the moderation in global goods prices. Freight costs have come down, supply chains have healed. It's quite obvious when you look at the underlying data, you actually see, outright falls in prices for some goods categories and certainly disinflation across others. The real challenge for Australia, I guess, is going to be what does services inflation do from here? So obviously the RBA kind of targets inflation in aggregate, but I think, primarily concerned with what are the true domestic pressures. Wage costs are a large sort of important component of that. And I guess we worry about it, or we think about it a lot, because we also know that once those factors sort of gain momentum, maybe they're a bit harder to sort of bring back in line. But we do expect wages are around their peak. We also know that on the services side, there's been a lot of other wage pressures in business, overheads such as commercial rents, utilities, even insurance is a big one. So just to show you this, you can see the importance in this chart of, how much home building contributed through the pandemic. It's come off, that's helped us, but it is still a bit high. Trade exposed things, so those goods I was talking about, have certainly come back a fair way. But for now, the services side, which is less trade exposed, has kind of stayed a bit stronger. And obviously, we'll be keeping a pretty close eye on that to see where inflation kind of is expected to settle. So kind of wrapping that all up, and where do we think we go from here? Well, we think the RBA's peaked quite clearly. Most people do. We expect them to stay on hold for the next few months. But, late 2024, so we've penciled in November, the RBA will have the scope and the increased confidence, we think, on our forecast at least, to begin easing the cash rate. So it's important to remember it'll still be kind of restrictive. It's well above its long run average, or a little bit above its long run average. But, with inflation kind of returning back to target, or at least looking to, the RBA will be able to put a bit more weight on that sort of trade-off of growth and employment, and hopefully be able to navigate that kind of, let's call it soft landing, and bring rates back to something a little bit more neutral. So how do we think that all plays out? Well, we think we're around the trough in growth, hopefully, as consumption picks up. Activity will as well, something closer to trend next year after a relatively slow year this year. Unemployment, we expect to continue to rise. It's been a bit volatile. We'll get some data later in the week, but basically we expect it to rise to something around 4.25%, 4.5% over this year, which is actually still a little bit below its pre-pandemic rate, and inflation to continue moderating. So probably be around the top of the band on our best guess by the end of the year, and into the top half of the RBA's target band by the end of next year. So I might wrap it up there for now and hand over to Mark to take you through the property side in a little bit more detail.
Thanks, Gareth, and good morning all across Victoria and Tasmania. Great to have the opportunity to join you again. I'll try and do justice this morning, giving you a broad update right across the property sector, and also touch on rent rolls. What is interesting to reflect on as we start today, and just anchor our, the importance of property, but bottom right-hand side, just since we were last here, the value of Australian property is up by another 0.2 trillion. So in 6 months, that, as Gareth was saying, that growth has continued across residential property nationally. Today, we'll give you some glimpses of the national picture, but obviously focus our attention on the two states that are with us today. So just to set the scene, Melbourne here and Hobart are probably, in relative terms to the rest of the country, experiencing a period of consolidation and softer conditions versus some of the more challenged cities for availability of stock and housing more broadly, such as Perth and Brisbane, and to a lesser extent Adelaide. So some higher listings in Melbourne and Hobart is at the current state generating that softer conditions, both as you can see here on an annual and quarterly basis for both houses and units. This gives you for the 3 months that picture, and bottom of the page you'll see for the quarter, Melbourne growing, easing by 0.2 for the quarter, and Hobart just up by 0.1, and then regional VIC also off by 0.3, and whereas regional Tasmania growth by 1.1% for the quarter. And you can see as amplifying what Gareth has already shared, that movement over the course of the last 10 years that's been occurring, both for capital cities and for the regional markets across the country. If we look at below the headlines, it's always good to look at what segment of the market is growing. And what this slide shares is the most affordable quartile of the market. That's the 25th. The middle 50% and the 75th quartile, which represents the most expensive quartile of the market. And in Melbourne, it's the most affordable quartile that's growing, softer conditions at the top end. In Hobart, it's the lower and mid-range part of the market that is experiencing softer conditions, and the most expensive quartile of the market is showing the growth. Just to give you a sense from a sales point of view, you'll see Melbourne and Hobart sales compared to the 12 months prior are both up. In regional markets, both Victoria and Tasmania, year on year, you'll show some easing in conditions in both those markets, recognising that we've come to a point of more normalisation of that flight to trees and sea changes that was occurring during the pandemic period, and that's more normalised since then. If you look at Melbourne specifically, for the period of March, the conditions were very flat, eased 0.2% for the quarter, but remain 11% up prior to the pandemic start. As you can see, their listings are up 3.5% at the same time last year, but sales are up even more so. Days on market just eking out a little bit longer, one extra day, vendor discounting a little bit less, and growth in Melbourne rents, as Gareth's already touched on, rents is one of the key stories that we continue to touch on nationally. Melbourne up just about double digits across houses and units there for the last year. If you look at the regions on a heat map, you'll see here the deeper the blue, the higher the growth, and the more orangier colours are softer conditions. So it just gives you at a visual what's happening around the Melbourne for the quarter to the end of March, first quarter of 2024. And then bringing this to life in a tabular format across each of the regions, you'll see both monthly and quarterly growth. And largely the northeast and southeast and Melbourne inner are the areas experiencing most growth. On rentals, it's the Melbourne inner east at 21% growth, and the inner region more broadly at 20% growth in rental values. That's experiencing the most growth in conditions. Selling days, the outer east selling in 24 days is the tightest. Melbourne West out to 41 is the longest across Melbourne. And compared to the same time last year, it's the northeast, which has got more sales activity up by 8.4, followed by the Melbourne West region at an SA4 level up 5.4%, just to give you a snapshot of what's happening around Melbourne. This gives you some of the rest of the information at sales levels and of course at a listings level as well, compared to same time last year, but also compared to the 5-year average. Gives you that sense as to where conditions are currently at. Recognising listings have improved, compared to when we were last year and earlier this time last year, where we were more fighting for listings. The good fight is still on, but conditions have prompted some further easing, which increasing listings, which has eased that fear of missing out and resulted in the market more broadly tracking sideways largely since November. If you look at the regional markets, you'll see here each of the regions, monthly, quarterly again, and it's Shepparton, Northwest and Geelong showing stronger growth. Rents are largely up, mirroring some of those same trends. Shep and the Warrnambool and Southwest are leading the charge there on rental increases. Selling conditions across the regional Victoria, Mildura selling quickest at 36 days, and Woods Latrobe, Gippsland longest at 66. And more broadly on sales activity in Ballarat, then followed by Geelong, the two regional markets experiencing most activity. We turn briefly now to commercial in Melbourne. We'll round out the Melbourne update before we move to Tasmania. At a snapshot level across the main commercial types, industrial market has continued to soften. Really, two different markets emerging here. Off the back of the strong price rent growth, there's certainly been a renewed interest by owner occupiers to buy their own property and secure their own future. At a top end for investment properties, there's been some easing in the yields that are being paid more broadly as a factor of what's been happening across the interest rates more broadly, and starting to see that decompression flow through this particular asset class. Record low levels of vacancies have eased a little bit to edging back to more normalised levels. And albeit it is fair to say the sales activity, particularly for a larger transactions, still remains pretty subdued, with just 7 transactions in the first quarter of the year. Retail, in contrast, is starting to see more activity. Largely, retail had been experiencing an adjustment of conditions well before COVID arrived, and so it's perhaps more advanced in coming out the other end of those conditions. Leasing rates continue to be positive for renewals, apart from still some CBD related areas still to wash through. Most of those conditions are starting to improve. And there's certainly been an uptick in activity of key property sales, albeit largely it is privates rather than institutionals that are more active in that space as well. Perhaps least through the transition is the office sector. We've all well versed now with the flight to quality, so that's end-of-trip facilities, the accommodation, the grading of the building, the neighbours' ratings, etc., that are attached to that. But for secondary stock, there's still some evidence to come to market and still to see those transactions starting to occur. So top end starting to emerge with some transactions. Secondary still pretty challenged to get properties away, particularly in the CBD. Suburban office, however, has shown, particularly for smaller properties, some selective activity in that space. But there's still new supply coming through, particularly in the CBD, and still some transition to go through that office reset as a result of companies working out what their space requirements will be going forward, resetting rents post-COVID, and more broadly with that flight to quality continuing. We turn now to rent rolls, particularly in VIC and TAS. You'll see both some multipliers and some key insights of the drivers that we're seeing occurring across the transactions. We know more broadly there's quite a degree of government and taxation-driven activity occurring in the space, and if you're in that particular sector, we know you'll be working very hard with landlords to work through what is the right strategy for them. More broadly, there's continues to be staffing challenges and to service the space, and more broadly also the improvements in rents are also supporting the space more broadly. So just a snapshot there for you across VIC and TAS. If I move now more broadly to Hobart, and this gives you a glimpse for as we start our movement into Tassie, where the conditions are. This is housing in Tassie now, up 0.2% in March and 0.1 over the quarter. As I said earlier, largely it's tracked sideways for the latter part of last year, but is up 28.3% higher than when COVID initially commenced. Rents perhaps the softest in the country, recording easing in both those markets, reflecting supply demand, and you'll see their average days on markets in Hobart have lengthened out to 42 days compared to 28 at this time last year as well. Just giving you that same graphic across Hobart, remembering the deeper the orangey reddy colour is markets easing, the bluer areas are where the market has shown growth. Again, if we look around the island, you'll see some of the key local conditions. You'll see it's Lonnie that's shown the sharpest rate of growth for the period of time, 1.6% in Launceston and the northeast during the March quarter. Dwelling values, again, it's west and northwest Tasmania that's showing the most rental growth, recognising more broadly the softer conditions overall. Hobart itself, 36 days on average. Southeastern Tassie, the longest period out of an SA4 region, out to 57 days. And more broadly, just an update there on sales activity as well. So that probably is the right spot to pause and throw back to Adam for a number of questions that you might have. Just a reminder, put them in the chat and Adam will host Gareth and I for questions.
Good on you, Mark and Gareth, and thank you so much. I'm still reeling from the insight that coffee is a discretionary item. But I don't agree, Gareth, but I get the point. There are a couple of questions that have come in, and actually there's a couple of participants with their hands raised. I'd just ask if you've got your hand raised, if you could post that as a question in Q&A, and we'll be able to get to that directly. There are a couple of queries that have come in though, so let me throw to those. And Gareth, I'll start with you, and it's a question around not just the conflict that we're seeing in Eastern Europe, but also, it appears that things in the Middle East are starting to get a lot more serious as well. Just should that continue to scale up and and that conflict, become even larger and more sustained and involve more countries than what it does today, what's the likely flow-on impacts from an economic perspective from that, Gareth?
Yeah, I think we're watching pretty closely. It's just another one of those factors, right? Though all the pandemic impacts have faded and we've had, Eastern Europe, and now we have the Middle East. I think, what we sort of initially saw was, again, a pretty big spike in oil prices, shipping and freight costs. It doesn't impact our trade all that much directly, but where it does really feed through, I think, is, energy prices, energy costs, which have been a big story for us. Maybe a bit of the good news is that the fear around shipping has eased a little. Ships generally have to travel a bit further and takes a bit longer, but prices have actually recovered a little bit since that started, but it is a risk. So I think, as is the case with most of these things, it's really a confidence of financial markets and those kind of channels back to Australia and global capital markets that will be quite important. So for now, relatively contained, but obviously everybody's watching quite closely. I think, it doesn't go much to helping the weak business confidence and consumer confidence we're seeing, despite the fact the economy's held up. So yeah, watching that quite closely.
Good on you, Gareth. Thank you. And Mark, a question's just around, I suppose, what NAB is seeing from an operational sense, but also how we help our clients, get in and get out of the market every day. What are you seeing from a NAB valuations perspective in terms of, where is the increase and decrease been in demand sort of across property asset class?
No, good question, Adam. And certainly, construction activity in new growth areas, that's been more subdued, and still full confidence to come back in that build your home property post, I guess, all the series of building related challenges last year. So construction area there. So there is definitely more activity to be able to see, touch, feel property having been built, so I know what I'm getting into. That's not to say all construction activity, but just certainly much more pronounced than it was. So that would be one probably overall theme. From a more localized activity point of view, with Easter being earlier, school holidays being earlier, just the last 6 or so weeks has been a bit more disrupted compared to year-on-year averages, but certainly more activity and more broadly in that still occurring in those growth areas to get into the market. First home buyer or earlier home buyer is certainly still active, which is interesting as well. So perhaps still a little bit more heightened activity from investors exiting the market. 4 in 10 of the sales at the moment here in Melbourne are investors leaving, which is above the national average, which is 3 in 10 currently.
I understand it. And look, digging deeper on that, so a question from Jason where Jason asks, with expectations of input costs easing in resi construction, do we believe that constructions will drop?
Yeah, I think I'll jump on that one. I think Mark can add to this. He's got some on the ground feel and experience. I think it's a huge issue for a few reasons, but I think, when we look at the kind of underlying components of that graph I showed with the residential construction costs, steel prices are probably the only real thing that have sort of come off. They're still 30% higher, like everything. So, there's been a bit of a turning there. I think the issue is, almost every other product, so timber, ceramics, tiles, bricks, anything you can think of on the housing side is quite, high still. It isn't falling, and it will be important how that sort of plays out. I think in the construction business sense, we know there are some challenges there. It certainly matters for the cost of new housing, and it matters for inflation, right? So I think we're a bit uncertain at this point. It's certainly eased, but we don't expect huge or large falls right in the near term. It's kind of how does that adjustment, I think, on that side, labor is an emerging sort of issue, labor supply, given the capacity constraints in the industry. But that graph is also about houses. The other challenge we have is the bigger, higher density kind of apartments story is also challenged, right? So concrete, energy production costs are quite high, and also just the competition from quite large infrastructure projects at the moment are sort of drawing resources away. So it is a bit challenged. At least demand is quite strong and supportive in a sense, but there certainly does need to be some adjustment. But I'm not sure if Mark can add too much to that.
Perhaps just a couple other remarks to add. Certainly, I'm probably not in the camp that will see it reduce, Adam. So maybe the rate of growth will moderate, but I don't think it'll ease. We've seen no real signs of that really evident as yet. Adding to difficulties in getting trades, coordinating a timely build is still really challenged out there in the field. And then with the higher NATAS standard for building codes more broadly, there is some higher cost involved in building a 7-star property than there was previously, when that becomes a requirement later on this year in Victoria as well, Adam. So I don't think it'll reduce, but hope we're all cheering on that it will moderate and become more sustainable. But it definitely will need some more trades to be available to be able to support that.
Thanks, Mark. And thinking about there's a lot of budget work coming up. So Treasury in both states and the Feds are going to be, they're pretty busy with the whiteboards at the moment, scribbling out their ideas and doing those costings. As part of that, certainly what's been an acute issue in Victoria to sort of help allay its deficit. There's really been a ramping up of land taxes. Gareth, I guess, care to cast your mind forward a couple of weeks into when the VIC budget gets handed down, what we might see around the land tax issue?
Yeah, I think it's a tough question. I think we probably won't see too much change in the near term, just the way the politics and the budget is going. I think you're very right. So, fiscal policy is something we learned over the pandemic is quite important. One of the challenges governments will face is that sort of debt sustainability question. So we don't think anybody's too out of line or anything like that, but it's really about, as interest rates stay higher and the cost of borrowing is higher, how are governments going to manage that? And, I think the federal government has had some pretty large windfalls in a sense from commodity prices and, better than expected employment and lower unemployment. And it looks like we'll get a very large surplus at the federal level. The states are a little bit more challenged, but even then, places like New South Wales have benefited from the strength in property, and Victoria is obviously faced into some different policies as well. So I think, in the near term, if I had to speculate, I'd say not much change. But I think, at the state level and the federal level, it just really goes to the point that there is a bit of a burning platform here to kind of think about our tax mix and what do we do. And hopefully we start seeing a bit more of that and a bit more coordination between the states and the federal government, particularly on the housing supply issue.
Thanks, Gareth. And those, just to extending that, and that question was asked by Jeff, but just extending that a little bit further, do you think that we are likely to see any direct stimulation into the housing market, first home buyers, incentives for downsizers, sort of anything come through the upcoming state and federal budgets?
I think we'll see a little bit more. We've seen a bit over recent months or recent years, sort of, Queensland's probably the last major sort of announcement in kind of their support for first home buyers from memory. I think the real challenge there is, typically it's always been kind of demand side. It's quite challenging at the moment. I think there is a role for social housing and public housing, but it's actually, like the government can't build everything and the problem is bigger. So, what I hope, or I guess, the federal government had started going down this route is that we think a bit more about the supply side and what sort of incentives or support they can kind of give the states in actually, addressing supply. So rather than just doing kind of the demand side, maybe we deal a little bit more with this coordination issue, and that goes right down to the local government issue. So certainly challenging. I think it's a very large topic. It's very politicized at the moment, but it is a bit of a burning platform. So while it's a big challenge, I'm actually kind of optimistic that at least it's getting a bit of momentum and people are thinking a little bit more deeply about how do we address these structural issues going forward.
Thanks, Gareth.
Perhaps the only one, Adam, just to add on in the shorter term, the granny flat changes. So, for example, here in Victoria, certainly was an area of perhaps more rapid supply. Lots of the other planning and other coordination take years to see the benefit of that, and certainly I think there's a more immediate need to address the current challenges than waiting for supply more broadly to become available, just given the lead time of that. The issue wasn't created in one year or 1 3-year period. It crept up on us over a decade. Many of the people on this webinar today would have been advocating for different policies for all of that time, but it's taken till it's got to the consciousness of federal, state, and the community more broadly to get to this level of activity, and still more needs to be done, Adam, I would sense.
Yeah, excellent, Mark. But there's a question here around rent rolls and the rent roll valuations. Mark, it first touches on some trends, and I can maybe cover that one off. So leading a team of 12 bankers that focus on this sector. But then if you'd be so kind as to elaborate a little bit more on the sort of transactions that you're seeing. I think trends in the market, we are seeing that property management functions are certainly most focused on efficiency. They're appreciating the low vacancy rates and the increase in rents, which appear to be fairly broad across sort of all asset classes, all sectors. We're seeing a lot of M&A activity, those businesses that are specifically out there to cover a sustained decrease in some sales commissions. There are some agents that I've been speaking with that maybe think they might have gone a little bit early on holding on to some of their property managers. That is, that they're sort of now left with some really highly paid property managers and not necessarily the growth in supply in order to cover those costs. So there is some profitability impact where some property management functions have taken a bit of a haircut in their profit as a result of some of those costs increasing, the top line increasing, but not by the same rate. And so we're seeing a lot of discipline around the expense base at the moment. And then from an M&A perspective, we're seeing a lot of consolidation around the 500 property mark. Sort of those that are, have 1,500 properties are going to 2,000. Those with 2,000 are getting to 3,000. So a lot more scale that is starting to take place in agencies across the Melbourne Metro, and understand that there's been some very some sizable transactions that have taken place in both Launceston and Hobart recently as well. But Mark, just more broadly around sort of trends in values.
Yeah, perhaps to add to that, they're the underlying drivers, Adam, as you've identified. Scale, rent growth, of course, big drivers in that space. But certainly, we're still seeing a continuation of succession planning and some business sales that obviously those purchasers are looking to take advantage of to bulk up as well. So there's that element still occurring across the market. Similar themes in that sense that we've shared in the past, Adam. But yeah, values holding and certainly benefiting from that rental growth as well.
And look, if I could take this opportunity for a plug, guests, and that is that NAB will be at Australia's premier real estate conference this year, AREC. That's on the 26th and the 27th of May in the Gold Coast. So if you do run an agency or you are heading up as part of a property management function, please call in and say good day. We'd love to have a chat. We've got some really exciting developments in our transactional offering on the way that we can't wait to talk about when we're on the Goldie. But Mark, just a couple more questions before we wrap up. And that is one around listings. They're up on their long-term average for Melbourne. Any view on what that's going to look across FY25?
So I guess I would be. I'm in the camp of it will start to normalise as activity gains momentum into spring and into 25. Adam, with the taxation adjustments that we've got moved in the middle of the year, and as people get more certain around the interest rate environment later this year, as Gareth's mentioned, into 25, I think that will that surplus supply or the additional listings, that supply that exists today, will return to more normalised levels over the longer term. So I think it's a smaller window rather than the long-term structural trend. And so, I think we'll be back talking about the challenge on getting listings before we know it.
Good one, Mark. Thank you. And look, final question, Gareth, which would appear to be for you, but gentlemen, you take it as it comes. If building costs are not moderating, which limits supply, and investors are exiting the market because of increased taxes and regulations, what are your forecasts for rental inflation over the next 3 to 5 years? So long-term rental inflation.
Yeah, I think it's the very thing that worries us on a CPI front. We know that advertised on new rents have grown quite strongly. They've been doing about 10% a year for a couple of years now, and basically, the CPI measure, which is all rents, is going to have to catch up. I think that there's two sort of sides to this. Population growth will ease, over the next year and a half or so. So, the level of students and the catch up from the skilled migration program looks to have sort of run its course. And when the migration outflows kind of then normalize again, population growth should return to something a little bit more normal. Very much to the heart of the question is what does the supply do? So, it doesn't mean that the supply side is going to resolve. And so it looks like, the pressure will stay there on rents for quite some time. I think it's, we haven't hit it yet. It's a necessity or an essential, but basically it will pressure affordability even more, I think. So see if Mark has anything to add to that, but we certainly don't think they're going backwards anytime soon. It's just that where do those kind of affordability constraints kind of bind and the balance sort of ease off a bit?
Yeah, certainly from my perspective, it'll take a lot more supply and a lot more of the announcements to actually turn into available houses before we're talking about it normalising, Adam. So, in that type of time frame, it's not convinced at the moment from what we're seeing that there'll be an adequate supply response.
Thanks so much, Mark, and thanks, Gareth. That brings us to the end of Q&A. So I'd like to, as I said, thank both Mark and Gareth for their insights and their expertise. As I mentioned, my name's Adam Holster. I lead 12 bankers who specialise in this sector, specifically for real estate agents, but also the advisory community. Really look forward to getting in touch through your banker or directly to me. You can get onto me through LinkedIn. Mark and Gareth are always up for a conversation through that channel as well, so please feel free. This content will go out as part of our follow-up, so please feel free to take that and share it with the teams that you lead or that you're a part of. As we close this today, you will be directed to a couple of questions survey. It does help us make sure that we produce the right content that really helps you make a decision or form an opinion on the market. If you'd please stick around for that, that would be tremendous. And until next quarter, it's bye for now.
Thanks all.